Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Hello, everyone. Welcome to the March episode of Cup of Joe. And I'm Mike Carrazzo. I'm having some difficulty here again. Can you all hear me?
Yeah, we can hear you.
All right.
Yeah.
I'm a little gun shy after last week. But welcome to the show. Welcome to March. Certainly a lot going on here. Ryerson welcomed some new family members in the past to the Ryerson family. I want to say a big shout out to Olympic Steel. That merger has been official. If more information, we have a video with Eddie Lehner and Rick Mirabito on LinkedIn. So we get a fair amount of questions here on Cup of Joe. We just never bring them to the surface. We haven't had the answers yet. So now Eddie and Rick will have all your answers there on LinkedIn. So really just a welcome there and exciting times ahead. And speaking of exciting times, it's Nick Webb, our Director of Risk Management, Commodities Hedging. What's going on, Nick?
Not a whole lot, man. Actually, I take that back. There's actually a lot going on this month, but you know, we use that as a colloquialism, I suppose. But how are you doing? I'm shocked that it's March already.
Yeah, it's the year's really going by fast, and it's getting a little warmer, which is good. But yeah. March in Chicago is, you get warm, then you get cold. It's like, fall spring. That's what I've heard
exactly
a few times.
I think we have about 6 or 7 phases of spring.
Yeah. But as you said, there's a lot going on. We got a jam-packed show on the macro side and the commodity side. Oh, and we decided to squeeze in a guest too. We're going to be joined halfway through the show by John Shipman. He's the non-ferrous long product manager for stainless. Well, non-ferrous would be stainless. Duh. So I'm really flustered this month. I apologize.
You're good.
John, give us a little intro for you.
Yeah, sure. First, Mike, Nick, really appreciate you guys having me on. Really excited about the show. So title is non-ferrous long products manager. I've been in my role since this past August, so coming up on 6 months here. But prior to that, I've been with Ryerson for 7 years, all on the sales side, and a lot of my exposure over the last couple months has largely been in our stainless long products, as well as red metals of all forms. So we'll get into more details later, but appreciate you guys having me on.
Yeah, we do a lot on the commodities. We don't touch on long products a lot. So when Nick and I were talking, why don't we get into some of that? So I think it'll be a really exciting discussion, John. So sit tight. We'll get to you in a bit, but there's some macro updates that we need to get to. Take it away, Mr. Webb.
Excellent. Let me get this shared over. All right. As we always have to do, we need to cover the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, John Shipman, and not the opinions of Ryerson. We have a lot of great content to get through. And when I say great, some of it's very turbulent. It's coming at us hour by hour, but we're going to give you the freshest takes that we've got, that I've got. And let's go ahead and get into it. So as we often do, we like to go around the world and see how global PMIs from the S&P Global survey are looking. And again, for those who are seeing this now for the first time, over on the left-hand side, you can see all the regions of the world. And then going left to right, we're going from 1 year ago to the right-hand side, which is the most recent survey data points. You don't need to see the numbers, more so just look at the colors. But what you can see is in the last couple months, we've begun to see a little bit of a rejuvenation in the surveys, really around the world. When you look at the top right corner, the global figure has jumped from, where we would have been a couple months ago, kind of in yellow territory, right around 50. We are in most recent data sets showing a weighted average of 51.9 on the global PMI. Here in the United States, it's a little softer than that at 51.6. But when you go down vertically down the column, you can start to see that we have seen a general shift, not just in the United States, not just in in North America, but really on a concerted basis, we're seeing a little bit more green creeping into these surveys. So a bit of optimism starting to creep in over the course of Q1. When we look at a different survey, so this is going to be the Institute of Supply Management shown in the blue line compared to the S&P Global, which is shown in the white. We highlighted this in prior couple of Joes, but there were a number of months in mid to late 2025 where the S&P Global survey, which again is the white line, was just showing a divergence of optimism relative to the ISM. And it kind of had a scratch on our heads because one was saying something that was slightly negative. The S&P Global was slightly positive. Well, fortunately, we now no longer have to question which one was right because they're going in the same direction. You can see just in the last 2 months, the ISM data has moved substantially into positive territory, not gangbusters territory, but right around 52, a little above 52 on the ISM. So we now have what looks like a kind of a concerted in sync survey result of both sets of manufacturing data are suggesting a bit of growth is picking up. And I would say this is a bit of a welcome surprise for us here at Ryerson and hopefully many of our customers, where order activity is beginning to pick up, certainly relative to the last 2-3 years that we've seen where it's been pretty soft and not great conditions for manufacturing activity. When we peel back the onion, this is looking at the ISM data again, just in a slightly different way, a more granular way. Up in the top left, I've highlighted a couple sections, but the headline number, again, we wanted to see if last month we mentioned that we saw a big jump in the ISM. It jumped up to 52.6. The question was, is this a 1 month thing? Is it just going to be a drop in the bucket and then fade back lower? Well, it looks like it's the beginning of a trend. Again, it's only 2 months in, but we are still hovering above 52, which is a pretty decent number. I think what's even more encouraging is the fact that we're seeing new orders up at 55.8, which is coming off a very strong January as well. So those two data points are suggesting, and they tend to be leading indicators of a pretty positive dynamic as we roll through 2026. The other positive one that I'd highlight is going to be the backlogs of orders, which has jumped from 51.6, again, positive territory, but jumped all the way up to 56.6. So those are the highlights on the positive side. I think the hurdles, and this is probably more in the realm of, do we cut interest rates, things like that? Are we seeing a ramp up in inflation? Prices have jumped all the way from 59, which is already pretty deep into growth territory, all the way up to 70.5. And for those who buy metal, probably not a big surprise because we've talked about this in many Cup of Joes prior to this about the inflation that we are seeing in various industrial metals, but it is showing up in the surveys as well, which I think is definitely something that the administration currently, I would say the Federal Reserve is probably keeping a close eye on that one because 70.5 is a pretty exorbitantly high number. And then counteracting that is a relatively soft employment picture. So again, the Fed's dual mandate is to kind of keep the employment situation intact while also getting prices lower or somewhere around 1% to 2% on inflation. Right now, they've kind of got both going against the grain where employment's a bit soft, particularly in the manufacturing space, and prices are going exorbitantly higher in many cases. So that's a bit of a negative hit or maybe a negative outcome of some of this growth that we're seeing.
Hey, Nick, it looks like the thing that jumps at me is imports, 4.9. Is that surprising given the landscape of everything going on with tariffs and everything that imports are up 4.9?
Yeah, a bit. Although I will say that there are some categories, and what we've got some charts on import data where I think some categories are simply saying we pay the tariffs, so be it. There could also be a little bit of front running, and we'll talk about some of the tariff changes that have happened in the last few weeks regarding IEEPA tariffs. There could have been a little bit of front running trying to take place to get in front of any of those Supreme Court rulings. But yeah, I'm with you. It is a little bit of a head scratcher given the fact that we have, particularly in metals, Section 232 tariffs of 50%.
Yeah, interesting. Okay.
And so everything we've gone through as far as survey data, so that's the S&P Global survey, that's the ISM survey. We want to look at hard data too. How's the actual spending looking? So we look at industrial production as one good gauge of that. And it's telling a similar story, which is over the last, I'd say 6 months or so, we've seen industrial production growing on a year-over-year basis at a better and better clip. It's It's a little choppy, but you can very clearly see the trend since the end of 2024 through now. We've gone from negative territory up to north of 2%. So this is again corroborating this optimism as we begin the early months of 2026. And looking at durable goods data, this is one that unfortunately in prior Cup of Joes for the last few months, we weren't able to get this data very fresh because of the government shutdowns in Q4. This is beginning to get caught up. So we've got this data as of December. So again, it's a little lagged. But what you can see here very clearly is we've got a lot more bars over on the positive side of the territory than we do on the negative side. Some of these are going to be familiar culprits: non-defense aircraft shipments, industrial machinery, construction machinery, mining, motor vehicles doing decently well, HVAC. Those are some familiar categories, but they're certainly continuing in very positive territory. Some of the ones over on the right-hand side, unfortunately, are also familiar territory. Things like farm machinery, the ag markets continue to struggle. One area that I would highlight with non-residential construction spending, which is about 4 from the right, not really showing a whole lot of growth just yet. But we talked about this in Cup of Joe last month, which is the Dodge Momentum Index. The Dodge Momentum Index is, again, a survey done with architectural individuals to say, how are you seeing your bill, your work? How are you seeing your upcoming work? And then they construct this survey, and it's indexed back to 100, 100 being what the surveys would have been back around 2000. But what you can very clearly see is in the last, I'd say 18 months or so, just Mike, you love this word, a parabolic rise higher in these survey results. Why is that important? Well, this data, this index tends to lead non-residential construction by about 12 to 13 months, and it tends to have a pretty strong correlation right around 90%. So what does that mean for 2026 and maybe even early 2027? Is we should start to see the rubber hit the road on actual projects, on actual spending, on actual metal demand going into things like data centers, like hospitals, like schools. And those are the big culprits for where we're seeing a lot of this growth. So, there are a lot of people trying to time when is the bubble going to pop with regards to data center spending, data center CapEx. It doesn't look like it's going to be this year. So I would suspect that when we look at this non-res construction spending being flat, as we roll through the next several months, my gut would say that we're going to see those data points move into positive territory pretty rapidly.
Hey Nick, where does like aerospace and defense fall in that the index here, right? You have is that completely off this radar? Is that a different index because I'm thinking is maybe we might
defense for the most part is going to be off this one. Aerospace is going to fall still within the non-defense aircraft shipments. That's going to be more of like your commercial airliners and things like that. Defense there wasn't a category that I had found within the durable goods data to specifically track that. All right. Moving over on the topic of data centers, I thought this was an interesting little way to lay it all out. This is a map showing where all of the data centers are either operating already or where they're going to be projected to be built. And so the real moral of the story on the map is just there are hot pockets of where these projects are taking place. So to the extent either a customer of ours or a service center is operating in certain areas, there are going to be some major hot spots. Certain municipalities have better regulatory plans to allow for this type of building activity. But what I think is maybe most interesting is over on the bottom right-hand side, we're looking at the number of data centers that are either planned or under construction. And the total of those two is about 1,400 data centers, either planned or under construction. And my analysts were doing a bit of work around this, and we discovered that on average, the average data center consumes around 15 to 20,000 tons of steel.
Wow.
You multiply that times 1,400 data centers, you're talking about a meaningful chunk of an increase for steel demand. And we didn't even dive into copper demand, aluminum demand, cement demand, and the tangential need for manufacturing equipment. And so these are robust numbers, and they're not going to hit all at once. But But I think over the next 18, 24 months, maybe 3 years, these are meaningful drivers of commodity demand growth. And so I thought this is a pretty interesting, unique way to look at it all. Now, Mike was asking me before we started airing about the details around the most recent conflict, which is that in Iran and maybe more broadly in the Middle East. And, certainly want to be careful about how we talk about all this, but we just want to give the facts and how it relates to commodities, shipping, and everything that we deal with here within North America. So, what's happened? Basically, the supreme leader of Iran has been taken out, assassinated, whatever word you want to use. And since then, there's been a greater conflict. Seems like some retaliatory attacks. And I think maybe most importantly, with regards to commodity markets, what's happened is the level of activity of shipping within the area and the level of transit for just goods and services has pretty much come to a halt in the area. Now, why is that important? Well, it's important for a couple different categories. One is insurance rates in the area, or if any vessel is going anywhere near the area, insurance rates are either going through the roof or they're just completely non-available. So that's the first thing on shipping. So shipping has either gotten very difficult or it's gone stagnant. So the ability to access vessels is getting harder or just extremely more expensive. So that's the first bit. The second bit is going to be with regards to energy. 30% of oil trades through the Strait of Hormuz, which is that area right there, kind of in the Persian Gulf. And so what is that going to do? That just in the last couple of weeks, we've seen crude oil prices go from, I'd say, the low 60s per barrel all the way up to just north of $80 a barrel as we sit here today. So very rapid increases to crude oil, most likely diesel fuel. Certainly within Europe, we're seeing natural gas increases of 75, 80% in the last few days. So that's going to increase the cost of manufacturing, pretty much anything. And then lastly, and not many, we'll get into this more detail, but not many people think about the Middle East as being an aluminum hotbed, but it certainly has grown into a much more major player. The Middle East now comprises about 9% of global market share. So even if they're able to produce, even if they're able to access natural gas or whatever kind of power they use to smelt their aluminum, the ability to get it out of the Strait of Hormuz has basically ceased to exist. So we have seen increases in the cost of aluminum. We'll get into that in more detail here in a little bit. But where do we go on this? There are such widely varying ideas around how long this may last. There are some who are saying, this could be ended in a matter of days with a couple strategic, blasts or something like that. There are some headlines earlier today that are suggesting this could extend into September, which I don't think that is the base case of most who trade commodities, most who trade oil, because I've seen some estimates that are suggesting that if the Strait of Hormuz is actually closed and remains closed for more than 5 or 6 weeks, that we could see crude oil prices going north of $100 fairly quickly. So that's those are things that are certainly of concern for North America, certainly of concern for anybody who's worried about inflation of commodities or just inflation more broadly. And yeah, I think this is going to hurt transit of any importation of metallic commodities that we tend to rely on in many cases. So it's a messy situation for sure.
I read 3% of the global iron ore comes from Iran as well. And I mean, so you put that together, the 9% would say of the world aluminum. What is the what is the immediate impact for the metal buyer right now? What's going on?
Mike, I want to give that to you right now, but we're going to have to wait till after Mr. Shipman gives his presentation.
Oh, come on.
Because we've got a lot on how it's going to impact metals. But the long and short of it, I think I talked about the freight aspect. So anybody's relying on foreign product, cost of getting that vessel is going to go up. Cost of insuring that vessel is going to go up. You mentioned iron ore, but it's a pretty broad array of things. Whether you're talking about crude oil, most of the energy products, liquefied natural gas, You mentioned iron ore, fertilizer. Fertilizer is a big one that comes out of that region. So
Paint, right? Paint. I mean,
yeah,
you need petroleum to make paint, which paint and aluminum would probably be impacted too, right?
yeah.
You're
Yeah. So
talking
I mean,
about things. Yeah.
yeah, I hate to reference Jeff Goldblum in Jurassic Park, but yeah, chaos theory. A butterfly flaps its wings in the Strait of Hormuz, and all these things end up getting hit, particularly if this thing lasts for an extended period of time. So, yeah, this is an important bit to keep an eye on in terms of understanding where your supply chains are sitting.
It's and I don't mean to park you here, right? But like things happen in the world, right? And there's these effects, these ripple effects, right? And you can't things aren't going to be calm all the time. And it just shows you how one little, not little, this isn't little by any means, but we think, okay, this is isolated to Iran. Well, no, it's not. I mean, look at the impact it's having, this port here and the many products that it touches. So geopolitical, we were joking before, like, it's certainly been interesting since Trump's taken office, and everything. If you're involved with commodities, it's never a dull day, right?
Never a dull day. And like we always say, one of these days we're going to come on Cup of Joe, and it's going to be a 25-minute episode, and we're going to have nothing to talk about, and it's probably going to be glorious. It'll probably be really great because people won't have to hear Nick Webb's voice for too
You
long.
would never hold yourself to 25 minutes.
I probably can't.
No,
we'll figure something else to talk about.
Yeah.
But yeah, we'll probably revisit this slide and this content here in a little more when we talk about metals market. Switching gears, though, another kind of big thing that happened in the last 30 days was the Supreme Court ruled down. They knocked down the IEEPA tariffs, which the IEEPA tariffs specifically were with regards to fentanyl trafficking and all of the reciprocal tariffs that were initially put in place last April. I've gotten a lot of questions of people being like, okay, the Supreme Court shot down IEEPA tariffs. That should mean metals prices should come down. Well, not necessarily. In the case of metals, industrial metals, steel and aluminum, stainless steel, those are all still subject to Section 232, the 50% tariff against all of the world except for 25% against the UK. Those are still fully in effect. Similarly, almost immediately, the president kind of in a knee-jerk reaction kind of just said, I don't really like this announcement. I don't really agree with the Supreme Court. I'm going to figure out a different way to utilize my tariff toolbox and implement a new set of tariffs. And what he chose to use was the one that's down there in the middle section called the Section 122, which is the balance of payments authority. And what this is basically the president has the authority to do this if he thinks that there are large deficit issues. And this goes into effect for 150 days, at which point it can be renewed by Congress. Will Congress renew that or not? We don't know, but it's currently sitting at 10%. It's rumored to maybe bump up to 15% at the moment. But that basically just replaced the IEEPA tariffs. So, the long and short of it is, has anything really changed in the last 30 days? No, not really. And if anything, I would say the president has vocalized the fact that he kind of wants to even implement additional tariffs. And it sounds like most likely he would utilize Section 301 because Section 122 is against every single country in the world. And you don't have the ability to pick and choose which countries get that 10% tariff or 15% tariff. Section 301, you can apply directly to certain countries. My gut feeling is that President Trump likes the ability to target certain countries to use it as a negotiating tactic. And my understanding is that Section 301 is harder to put in place, but it tends to be a little stickier once it goes into place. So it's a little more legal background that has to go into work. But he's alluded to the fact that he's open and interested in doing that. Now, that being said, the fact that we've got all this turbulence going on in the Middle East, my guess is tariffs have probably taken a slight backseat for the time being, particularly given the fact that crude oil has gone from $60 to $80. That's already going to be a pretty inflationary impact if that sustains for more than a couple weeks.
Mm-hmm.
But yeah, I guess the moral of this story is the president does have a number of different tools in his toolbox with regards to tariffs, and it seems like he's willing to use them. So it doesn't feel as though we are headed lower. If anything, flat to higher on tariffs.
Yeah, IEEPA was more like the finished good coming in, right?
That's right.
Than the commodity. Yeah,
that's right.
You saw a lot of like the businesses rejoicing on that, right? Because okay, I mean, a smaller business, right?
Yep.
I won't focus on this product coming, either this or that, but not the actual commodity, correct?
That's right. That's right.
Okay.
But then the 122 is section 122 is basically reemerged that. So moving over to inflation, I think I've got two more slides and we'll kick it over to Mr. Shipman. So what we're looking at here is going to be personal consumption expenditures, which is a fancy way of saying a gauge of inflation. And, we kind of highlighted this within the ISM report. But what this is ultimately showing is it looks as though inflation has kind of stabilized right around the 3% area. And if anything, has maybe even started to tick a little higher. We're certainly seeing that within the manufacturing space of inflation moving substantially higher. But even on a broad basket of goods across PCE, that number at 3% is decently above the Fed's goal. But it'll be interesting to see how the administration and the new Fed chair, Kevin Warsh, how they deal with this as he gets into office. Are they going to try and prioritize a weaker jobs market, or are they going to try and prioritize inflation? I certainly know which way the administration, the president, wants it to go. But again, with crude oil and certain kind of major commodities moving rapidly higher, we might see some of these inflation data points not just stabilize, but actually move a bit higher in the coming months. And with that struggle, the expectation in the market, if you look here in the second column, the number of hikes/cuts, the expectation is basically between now and when Kevin Warsh gets into office, which is going to be early summer, there's no expectation of a rate cut within the next few meetings. But over the course of 2026, the estimates are hovering right around 2 cuts for the balance of this year. So that would take us down into an effective rate of right around 3.25. Not a big difference from where we are at the moment, 3.75, but I think any little bit can have long and variable helpful impacts to the market.
And you mentioned last cup of Joe that the incoming chair is a little bit more hawkish comes to metals, right?
That's right.
Yeah.
That's right.
Would that mean more of a cut? He'd be more in favor of a rate. I'm sorry, not cutting rates, but more.
I think if he's leaning slightly more hawkish, more kind of open-minded about where inflation is actually trending, I would say, if anything, probably more stability. And I think the important thing to note also is a Fed chair is not the only person in the room who makes a decision. There's an entire committee that would have to be convinced that cutting interest rate in the face of a rising inflation environment is a good thing. So that committee is going to be, if inflation is to continue to trend higher, I'd say lower odds that we're going to get more cuts.
Okay, so a lot of good stuff coming out of that macro area. You got the data center consuming a lot of metal, continuing to have put more demand in the marketplace. Obviously, the supply chain impacts that are going on with what's going on in the Middle East, and it's weird. Like inflation, I don't want to say takes a back seat to all this, but it used to be like one of our top headlines we would talk about in the macro section, and now it's like your last slide in the macro. Still very important, right? But it just seems that like there's just so much going on.
Yeah, I mean, it's not quite back to like 2021 levels where you just didn't know where you're going to get your next commodity or your next part or whatever. But we're not too terribly far from some of those categories, depending on the end market, depending on the product it is. Again, I think we are going to see, if this continues more than a couple weeks, there are probably going to be some situations where drastic measures have to be taken. What do I mean by that? It wouldn't totally shock me to see the U.S. start draining its strategic petroleum reserve to try and bring prices down, more availability of energy products down. Those types of things I think are on the table. And admittedly, that's the point of why those things exist. They exist to be reserves to try and help with efforts like these geopolitical situations.
Interesting. All right. So before we get over to the full commodities update from you, Nick, we're pleased to bring in, as we mentioned at the top of the hour, John Shipman. John is a product manager, specifically non-ferrous, deals with a lot of stainless. And, we talk a lot about pricing of commodities and tends to talk maybe on like the sheet side, right? But what we want to really get into is what's going on in the world of long, right? How does all this impact this differently? And of course, we have other product managers for aluminum and carbon and all that, but particularly on the stainless side. So John, for those maybe who didn't catch you at the top of the hour, do you mind just giving yourself a little giving the audience a little plug for yourself here?
Yeah, absolutely. Like I mentioned at the beginning of the webinar here, been with Ryerson for 7 years, but more on the sales side. Started from inside sales rep all the way up to inside sales manager, which was my recent position prior to moving over to the supply chain side as a product manager for stainless long products. Prior to my role, the stainless long products fell underneath our director of stainless for the North region and family of companies. But since his retirement back in August, we've split his roles amongst two people, myself and Andy Broderson, our stainless flat and plate product manager. And it's been a real benefit to be able to focus in on the long product side of our business and inventory profile to, better support our customers.
Great. Thanks, John. I guess just to kick it off, how are market conditions right now when the stainless long, right? Talking, lead times, availability. Is it much different like when we talk about flat products? Kind of what's the state right now?
Lead times tend to be a bit longer. On average, looking anywhere for, your vanilla grade size, bars, 6 to 10 to 12 weeks, which has been pretty steady over the last, call it 8 months. When we're looking at, your ornamental tubing, your structural tubing, similar area, 6 to 8 weeks, but getting into your seamless, your instrumental tubing, your A249, A269, that's where we're starting to see the lead times kick out. A part of that, I think, going back to what Nick was discussing earlier, is a lot of it has to do with the data center demand, larger bill of materials for special projects. Going back to the Dodge Momentum Index Nick referenced, in talking with the mills, they are seeing those bigger bill of material quotes coming through, bigger opportunities coming through, and that's where you start to see those lead times get kicked out. But from a market pricing standpoint, 2025, when it comes to stainless, was a very flat year, largely driven by nickel, not making any swings up or down too much. But since December, on your Type 304 product, I believe we're up close to, 12 cents on surcharge since December, and Type 316, you're looking at 25 cents. Again, largely due to the increases in nickel stemming from, increases in nickel production, but also, cuts in production as well with the back and forth over in Indonesia. So it'll be interesting to see how April trends towards, but right now it's been pretty flat. And for the most part, lead times and prices have remained relatively flat. Haven't heard much news or changes, but as we know more, we'll make sure to be getting it out to our sales reps and onto our customers.
Hey, John, maybe like 6 months ago when the Section 230 or when the 50% tariffs went into effect, we saw the domestic mills take base prices substantially higher on sheet products. Did they do a similar price hike announcement on long products?
That's a great question, Nick. And yes, they did. Anywhere from the tune of 17 to 30 cent plus base price increases. Going through 2 months of the year so far, we were all, myself and my counterparts were anticipating potentially another one. But so far, those murmurs, if you will, have started to fall away a bit. But, like you guys were talking about earlier, everything's constantly changing. So, but no words of or input of a base price increase on the long product side as well.
You mentioned data centers as one of the drivers. What else is really pushing demand right now for the stainless long side that you're seeing?
On the stainless long side, other hot markets outside of data centers, because that's front and foremost, but aerospace, medical, and also with oil and gas rigs. Obviously, the news over this past weekend and what's continuing into this week may affect that. But in talking with the mills, that's a lot of what the end use is headed towards. But there's more to come on that. Data centers definitely is the big elephant in the room. And we have seen, inquiries for data centers on specific types of materials where just that initial lead time to get product, it's getting pushed out a week or two every given day just because of the backlog that's growing. After that, we're positioned enough where we can support our customers who are working on those jobs by working with our mills on setting up a program to keep them in material. But that initial startup right now, it's about 3 to 4 months just on that initial startup.
In terms of application in the data centers, is that structural for the exterior of the building, or is that going inside for like the shelving? Where does that actually fit in?
More on the coolant side of
Okay.
the chips involved with the data centers. So
Okay.
that's more of your A270 sanitary tubing that we're seeing a bigger push for. And while we're working through these, we're still trying to figure out the amount of capacity here domestically in order to bring that lead time down. So that's been a hot one that we've seen over the past couple of months.
Is the import market still one that's open and available for people like us or our customers to access?
Yeah, there's been import opportunities. I would say on all commodities under the stainless long profile. In most cases, you would think that due to the tariffs, those prices would make you be looking elsewhere. However, I would say February, we did start to see an increased lead time due to the amount of production days in February being a shorter month, talking about anywhere from 4 to 5 months of import coming in. And so far, just as of this week with the recent news, have not seen many changes in the pricing, not many changes in the lead time, but it will be interesting come April how everything that's going on right now in the world will affect that.
Yeah.
Do you see a lot of customers, right? They're buying stainless flat. Are they buying long with it? Is it usually like a bundle type purchase, right? Are there,
Yeah.
I guess, if they're looking at one, is long kind of coming along with it? No pun intended.
Yeah, I would say I'm seeing more one-off long opportunities right now, but in previous roles on the sales side, we do see a handful of customers who are purchasing the plate for their tank building, but also you need the skeleton, if you will, on the inside with the bones on the long products. That's what we're really trying to bring to the marketplace is if we haven't had a shot at a customer's long product before, but we've been servicing them on the sheet plate needs, then we would openly and welcome an opportunity to take a shot at servicing them on the long product business as well. Just having been in my role the last couple of months, we're turning over stones that we haven't really looked at before and doing everything that we can to best service our customers in ways that we may have not thought of historically.
And kind of another shameless plug here, but obviously you're buying a bar or tube, you're going to cut it, right?
Cool.
I mean, so fabrication's a big part in all metal probably, but long in particular. And we've have some strengths in the long side, some recent investments in like University Park and some. Can you talk about some of those?
Yeah, University Park, being about an hour outside south of the city of Chicago. Under the roof of University Park, we have 4 Casto saws, 7 Amadas, 3 Sunnis, and a tube laser. Working to open up more capacity further at University Park. And beyond cutting material, we also have within our whole network family of companies, numerous folks who can polish material to a certain grit that you need in the Midwest or over on the East Coast. And like we were discussing earlier, it'll be 3 weeks from tomorrow since the Olympic merger. And we're just scratching the surface and learning from each other on what we can all bring to the marketplace. So very excited to see what enhanced capabilities working with the folks over at Olympic can provide. And another plug too with University Park is having one of our strongest mill relationships, having their depot 50 minutes from there. Similarly, how we work with our Shelbyville, Kentucky flat roll plant. It's a similar thought process with University Park. Being able to pull material from them right from the mill 50 minutes away provides huge advantages.
Mm-hmm.
You mentioned Shelbyville. Are there any long product capabilities that are of note for that facility, or you just said it's primarily flat roll?
It's primarily flat roll. I think for certain opportunities, we'd be able to have some stock in Shelbyville, but that's mainly a flat roll processing hub.
Okay.
Yeah.
I think before we kick it, I think once we get into more of the broader commodities discussion, there'll be some more to talk about. But I think what's important to note is we bring on product managers, and what we mean by that, right, John? I mean, there's something added that you can bring to the discussion with a customer, right? Solving unique challenges and problems, and talk a little bit about what that role is as a product specialist, a product manager, and what we can bring to the table there.
Yeah. Beyond a product manager, our task is to be the subject matter experts. Like I mentioned in previous roles with Ryerson, it was having to know a lot across various products and commodities, all different forms. Since being in this role, it's been, a real task of mine to solely dive into the product lines that I manage, make that my focus, and know the depths of it. When we're out traveling with the outside sales reps, and throughout our region here, we're coming in with a perspective for that product line. We may see things differently for that customer and with that rep, but also it's not just one outside rep who's going over to see, all the different customers in their territory. While we're talking with one customer in, let's say, Wisconsin, we might know of something in Pennsylvania that can help, collaborate and cross past that. We're able to work with the mills. We're able to help better service both customers. And that's been something that we really try to bring to the table and work functionally as a group.
Yeah, that's great and really valuable there. John, we're going to ask you to stick around for the commodities portion here, but we're actually getting some questions in here for you. So I'll save those till the end. So keep you engaged.
Sounds good. Thanks, guys. Appreciate it.
Yeah, and John, I hope it's okay that from now on, from here forth, I'm going to be calling you the Long Shipman.
That totally fine. I've heard that. Wouldn't say that's the worst nickname. It's a fun last name to make some jokes. So
you better hope that our CEO Eddie Lehner doesn't listen to this podcast, because for the rest of your career you will be the Long Shipman.
There we go. I'll let the family know. Thanks, guys.
Hey, thank you. All right, so I'm going to quickly go through copper because there isn't a ton new to report really on copper specifically, but copper, no doubt about it, over the last 5 years has been leading the charge in the industrial metal space. In my opinion, it's kind of given the reins over to the next metal we're going to talk about, which is aluminum. It's kind of caught fire and in a variety of good ways and also some bad ways from the supply standpoint. Seems like on the aluminum side, when it rains, it pours, and we're certainly in a situation where it's pouring. But yeah, on the copper side, we're still hovering right around $6 a pound. It remains to be a tight market, and I think probably remains to be so for the balance of the year. But switching over to the big one that we want to be discussing today, which is aluminum, and most poignantly the Midwest aluminum price, which is going to be inclusive of that Section 232 tariff. You can see it in the chart. When you look at the white line, we are at record high levels by a pretty wide margin versus 2022. We're all the way up at 255 now. You can see just in the last couple data points, when you look over on the very far right-hand side, you can see kind of a sharp move higher in both the LME and the Midwest Premium, and that's going to be centered around this Middle Eastern geopolitical conflict. We've talked about this in the past already, but this is more of a domestic supply issue. Just to reiterate, Novelis, Oswego out of New York, they are still expecting somewhere around Q3 to have this facility be impacted due to a fire that happened in late 2025. So that remains to be the case, but just continuing on the supply side issues. So focusing on the Strait of Hormuz again. So you can see over on the right-hand side, those who like visuals, that is the same strait, that is the same, waterway that is where all of the oil and natural gas travels through. But you can see all of those blue dots. Those are different smelting facilities for aluminum. and they're all centered right there in the exact same area. So the way I'm thinking about it is, if 30% of the supply of oil comes out of that area, 10% of the aluminum comes out of the area, whatever's happening to oil, kind of divide that by 3, and that's kind of what you would expect to have happen from a pricing standpoint to aluminum. Now, over on the left-hand side, there's a little bit more of a detailed table, and I won't go into all of the detail, but Aluminum Bahrain, which sometimes goes by ALBA, they announced in the last couple of days that they were going to have to declare a force majeure, which means they are not going to be delivering any aluminum. We don't know if that's going to be a couple weeks or a couple months. We've also got Qatar Aluminum, which is a joint venture with Norsk Hydro. They too announced that they were going to be shutting down operations due to a suspension of gas supply going into their own smelting production. And then last but not least, in the UAE, there's an aluminum refinery that's dependent on the importation of bauxite, which again requires vessels to be coming into the area. So that one's a little bit more unclear whether or not they have enough bauxite stockpiles to make it through whatever conflict we're going through. But the other two, Qatar Aluminum and Alba, they've effectively said no mas. And even beyond that, every other one of these facilities, you can see how closely they are geographically to the Strait of Hormuz. If the Strait of Hormuz is closed down, vessels aren't going out, and so whether there's force majeure or not, they can keep producing. It's not going to get out to the international markets. So this is meaningful. There's no doubt about it. So again, when it rains, it pours within the aluminum space. This kind of gives you a global market share pie chart. The GCC, that's the Gulf Cooperation Council, basically a different way of saying the Middle East, in combination with Iran, again, it's about 9% of global supply. Now, all that being said, even with that, we are, given the fact that we are at record high prices, and given the fact that we have 50% tariffs on most regions around the world, it's still being suggested that there is an import window or an import arbitrage to bring foreign product into the U.S., either on ingot or on common alloy or finished products, and simply pay the tariff, and it can come in cheaper than the domestic market. So again, those things take a matter of time to unfold, as Long Shipman was referring to, but my instinct is that at some point we're going to be seeing a decent ramp up in inventories. And what's interesting, I was having a look at this data earlier on the Department of Commerce website, and it kind of surprised to see that the trend is higher, but the trend is certainly higher over the last 4 or 5 months, that aluminum sheet, plate, and strip imports are actually on the rise, not on the decline, despite the fact that we've got all these tariffs that have been implemented, obviously these supply issues that are happening, but imports, and this will look very dissimilar from what you'll see on carbon and what you see on stainless, but the United States needs it. I would say we need it to better balance our markets. There have been enough supply issues, and the pricing is of a nature that I think there's an opportunity to bring in foreign product and hopefully better balance the markets as we roll into Q2, Q3.
Well, you know what I'm going to ask you, right? So 10% gets cut off from Middle East, all that coming in from Canada that's being tariffed. Where do you get aluminum, right? And I think you mentioned last episode there was plans for development of a U.S. smelter, Century, I believe it was, right? That could take years. I mean, so what does the aluminum buyer face right now?
Yeah, well, I think for the Middle East, it's a direct negative impact. So for anybody who's relying on metal coming through that area, anywhere near the Persian Gulf, at least in the short term, it's pretty much no mas. It's either got to be diverted in a massive way, which is just going to take longer to get here, or somebody's just going to cancel the shipment altogether. But you mentioned Canada. I would throw in different parts of Asia, Korea. Even though there are tariffs, we can still get metal from those regions. If there's an economic incentive to do so, even with the tariffs, people will go out and do it. So, I would say for the most part, it's not going to be cataclysmically detrimental to the U.S. aluminum market, but it is incrementally tightening things in what's already an otherwise tight market.
And just a point of clarification, one of the listeners is asking, when you said force majeure, is that reduced delivery or complete shutoff?
Force majeure typically means they are not honoring contracts to any degree, which it usually means they are not delivering at all.
Got it.
Yeah. So a lot going on aluminum. Switching over to carbon markets, I didn't expect this to happen. So I'll say I was wrong on this one, but we have surpassed the $1,000 mark on hot roll coil. Only briefly. We're currently sitting just north of $1,000, depending on the index you look at. But we are similarly seeing, when we look at the blue line, which is going to be Northern Europe, and the orange line, which is Chinese prices, we are seeing the Northern Europe prices rising almost in tandem. What does that mean? Well, it means that the import threat is reduced, because if the price of foreign metal is also rising commensurately or at least similarly, then the price of any import arbitrage is closed up. And you'd say, well, there is a large gap between the two, but you have to consider the fact that any foreign product coming to the U.S. is also going to get a 50% tariff. So I think the U.S. mills are recognizing that they've got a moat to kind of make some hay and really make some margins, particularly on the electric arc furnace side, because scrap pricing is not doing this. Scrap pricing is pretty subdued. But how high do we ultimately go? I think we're somewhere in the realm of where we begin to peak out, because I think if we go too much higher than this, I think we risk reopening the window a whole lot to places like Canada, places like Mexico. Maybe some Asian nations decide they want to start shipping into the U.S. and simply pay the tariff. So I think the cap is not too far from where we are. But admittedly, we talked about at the onset of this podcast, which is demand is improving. So some of this price recovery is being fueled by a demand situation that feels a little better than what we had seen in 2023, 2024, and 2025. So there is a little bit of a demand element that's tightening the market up incrementally, but still, in my opinion, at some point the mills will get caught back up. They'll view this as an opportunity to make a whole lot of money at these prices, and I think it's a matter of time until we see that. But when we look at utilization rates for now, we've seen a small jump from 74 to 78. But you look at this 5-year chart, we're nowhere near back to the mid 80s that we would have seen back in 2021. So I think there's still room for the domestics, not just the new ones who are going to be coming online later this year, but the existing domestics to bring capacity up a bit. I tend to think we probably will see that happen, but if for no other reason, just there's a profit motive to do so. But up to this point, they have not fully done so. And we talked about this last couple, Joe, but I just want to reiterate, this is a seasonal chart looking over the last 3 years, so 2022 through 2025. And looking on the left-hand side is going to be January, right-hand side is going to be December. The white line is your 3-year average of those 2023 through 2025. And when you overlay the blue line, which is going to be the current pricing, we're looking like we're on a similar trajectory to the 3-year average. I'm not saying we're going to wind up in an identical situation, and certainly there is that asterisk of demand does seem to be a little better this year than the prior 3, which is what we're comparing to. But all things being equal, when you start to get into these price levels, we are seeing backlogs at the mill level. They are trying to get caught back up. For now, lead times are fairly extended. But usually those things don't persist for massively long periods of time. At some point, they'll get caught back up. You'll start to see, them competing with one another on price, and then maybe you see a little bit of degradation. I don't know if that starts to happen at 1,025 or 1,100. I don't know where exactly the peak is going to be, but it does feel like the trajectory is playing out in a similar fashion to what we've seen in prior years. And the futures market kind of corroborates that. We look at just yesterday's futures curve. The market's basically saying that, okay, we're going to persist with hot roll prices and carbon sheet prices at very elevated levels for the next 2 or 3 months. But at some point, as we roll into May, June, July, like we often see with facility shutdowns and things like that, prices eventually come back down to earth. That's what the futures curve is suggesting will happen again. Can it be wrong? Absolutely. The futures curve can be wrong, but that's just how the market's viewing it at the moment. And again, we talked about this last month, and I'll go quickly through this, but there is a lot of new supply that's coming online over the next 6 months. You've got a rejuvenated Gary Works facility with the new investments coming into U.S. Steel. You've got Nucor up in the top right corner, Nucor in West Virginia that'll be ramping up. Steel Dynamics with Sinton. And then very late in the year, early next year, will be Hyundai Steel. And the only point there is to say, I guess, twofold. One is, it does seem as though, and I don't want to give too much credit to the administration, but the 232 tariffs have been seemingly effective in bringing new domestic productive supply online in carbon steel. And maybe you can maybe even make the argument in stainless steel as well. But certainly within carbon steel, we are seeing new productive capacity coming online. That should create a little more competition to better balance supply-demand conditions, maybe bring down prices a little bit. But as long as we see 50% tariffs on steel on every nation around the world, prices, the floor in prices has absolutely been lifted as long as that exists. Looking at imports real quickly, the import levels that we've seen over the last couple of months are at 10-year lows. So they are currently trending right around 5 million tons across sheet products on an annualized basis. So again, those are pretty depleted levels. Like I said, with the 50% tariffs, there isn't a whole lot of real attractive import activity, even with hot roll prices now above 1,000, cold roll prices around 1,200, which is pretty surprising. And it means, what it means to me is that the tariffs are in effect working to incentivize the domestic mills to continue to invest and ramp up.
Hey, Nick, before you get to this next slide, let me interject. You share your slides with me before the show, and I saw this next one, and I go, we never talk about this. I wonder if anybody's going to ask about this. We got a question like moments ago. Do you know anything on tungsten carbide? Is it your analyst that asked this question? I mean, it's the same. So hey, whoever asked about this, here it is.
Well, if it is my analyst, Joey, thank you for spoon feeding us the questions. You're front running the slides. If it's not Joey, then then we read their mind. But it is an important one, and the only reason why I brought this up is because it wasn't on my radar either until about a week ago. One of our sales members down in Cincinnati, Ohio, reached out to me and was like, "What in the world is going on in tungsten carbide?" And I'll readily admit I'm not a tungsten carbide expert, but I know how to research. So I started digging into it, and as you can see in the chart, the price of tungsten carbide in the last 12 months has, Mike, gone parabolic.
Yes, that's twice. That's twice today.
It's twice, yeah, but it absolutely is. I mean, this is the definition of a parabolic pricing curve. And what's driving this is mostly, again, from the supply side. It's less so on the demand side. But tungsten carbide is a big input into anything that requires, very strong heat resistance, strengthening, so hardening agents. And so things like saws, tools, certainly some energy related markets need that. But so as I understand it, China makes up about 80% of the world's tungsten production. And they decided very recently that they were going to essentially clamp down on the exportation of their own supply. So if that sounds familiar to what we've talked about in prior cup of joes, it should, because it kind of resembles that rare earth trade where China has 90% of all the rare earths production. Every other nation is trying to figure out a way to process their own rare earths so they don't become overly dependent on China, because China, if they want to, they can kind of clamp down and say, you all want tungsten carbide? Well, you're not going to get it for a little while. And what happens? People scramble in the market to try and get what is out there. And it turns out you got to pay a big price for it, at least for now. So that is really the story behind tungsten carbide. How high do we have to go before somebody actually ramps up a new facility? As I understand it, there is one in Canada that is beginning to contemplate turning on production just to kind of meet these higher prices, because things are getting very economical to do so. But I'm not going to overly promise that I'm a tungsten expert, so I don't know where exactly we go on this. But there's no doubt about it. If you're buying stuff for tool steel, it's a difficult market right now. So we feel like for
superhero tungsten carbide. Doesn't it?
we can make that a new RYI superhero if you'd like.
We could, yeah. Is this like primary element that goes into tool steel?
That's right. Yeah, I believe among all metals, it's got the highest melting point of all metals, and it's also a very heavily used strength hardening agent.
There you go. Tungsten carbide. Thanks.
Tungsten carbide. Didn't think we were going to be talking about it until just a couple of days ago.
Yeah. Good stuff.
And I think this is last, but as we talk about nickel and stainless, Long Shipman already touched on the fact that we've seen nickel prices jump on the back of the Indonesian announcement that they were going to rein in production over the course of 2026. Again, it was really just the headline. People didn't have to actually see export data or anything like that to make a knee-jerk reaction and move prices higher. But nonetheless, we have seen prices move higher. It's been a very volatile space. We've moved basically within like the 775 to 850 range over the last 2 months. It seems as though it's kind of magnetizing right around the $8 per pound level, but it's been choppy. And so day to day, we continue to see a lot of chop around that market. I still think it's a fairly well supplied market, particularly when you look at the LME nickel inventories, which aren't coming down. If anything, they're going slightly up since the announcement took place. So, in order to really put some legitimacy behind the Indonesia announcement, I think I would want to see this either dramatically stabilize or even come down a little bit on this chart, because that would suggest that they are actually taking efforts to tighten the markets. But as a reminder, we talked about this last month. The banks and the analysts out there, they have dramatically reduced, if you look over on the left-hand side, they have dramatically reduced their surplus expectations for 2026 from a figure of about 250,000 metric tons down to something closer to 89,000 metric tons. So still a surplus, but a much smaller surplus than where we had been. And over on the right-hand side, in terms of price forecasts, the price forecast has effectively gone from like $6.50 to $7 all the way up to 18,000 a metric ton, which is going to be right around $8 a pound, which is essentially where we are right now. So, and I won't belabor this chart, but ultimately, because of cost curves and how high we've gone so fast, most nickel producers around the world are profitable. Nearly all of them are. So for that reason, I don't suspect that nickel prices really have the fundamental story to go drastically higher than like $9 or $10. And I don't think they will, barring some sort of major supply disruption. But I think hovering somewhere in the 750, 850 range makes a whole lot of sense. It seems to be kind of the natural balance for where Indonesia wants things to operate, to allow their own local miners to make some money, and also to just well supply the market as well. And then last slide for us before we take some more questions, hopefully, is stainless imports. And I was actually sort of surprised to see this. It's not as dramatic as the carbon sheet import levels and how far off they've come. But we have seen a decline in stainless imports, which I was a little surprised about, just given the fact that, I think we've talked about this in prior cup of joes, the U.S. mills kind of took base prices so high that they almost left the import window open. And so we are still seeing, in many cases, some attractive import offers into the United States. So I was a little surprised to see the imports have dropped off as far as they have. Maybe that's people just being spooked a little bit, that they don't really want to play in the import game anymore, regardless of price, just because it's one where you can get burned on a Section 232 tariff or a 301 tariff. So, again, even though there is a market for imports to still arrive in the U.S., it looks as though people have kind of gotten a little skittish around it. Not massively so, but a little bit. With that, I think that what we got.
That was last but not least. All right.
That was last and least.
Beautiful. So great stuff as always, Nick. A lot going on in the world of commodities. John, really good stuff here. We're a little bit over. I'll give you some rapid fire questions here from the audience. Nick, what's going on with plate prices? Anything still divergent from sheet? Kind of where are we at with plate is one question.
Yeah, I actually haven't been looking at plate all that often. I mean, generally speaking, plate prices tend to correlate with sheet prices, just with a little bit of a lag. So I would suspect that we're going to see some elevated plate pricing coming, similar to what we've seen across the sheet space.
Question about the CSPs. Nucor's, I believe, is trending kind of how the CRU is, right? Do we know where Cliffs is?
Cliffs is effectively gone by the wayside. I haven't seen I haven't seen a single email about Cliffs number for probably 6 months. So I don't know if that's them just taking a back seat and saying, Nucor, you guys can have it and keep taking it higher. But yeah, my only comment on the CSP is it seems to have brought a little more stability to the way in which price increases occur. if we went back 2-3 years ago, it seemed like you get one mill who says, I'm going to hike prices by $50 a ton. And then you get the next mill doing the same thing the next day, $50 a ton. Another mill will be like, oh, I'm going $80 a ton. They were very dramatic, large jumps in the price of carbon sheet. What we're seeing in the CSP is it tends to be, okay, if it seemed like a decent demand week, they'll take it higher by $5 or $10. If it's a decent market again, take it higher by $5. And so we've seen just a very gradual stair step higher over the last, I'd say, 4 months or so. Mm-hmm. And I think that's probably a welcome thing for the market, where it's much more orderly. It's not creating as much panic from buyers to say, I need to front run this, because who wants to go out and front run a $10 move on a CSP? So I think that's brought a little bit of stability, and I think maybe even legitimacy to all the indexes, which tend to be following one another right now.
That makes sense. Yeah, I haven't seen anything about cliffs in a while. Yeah, maybe it has gone by the wayside.
Yeah.
John, do you have any insight on lead times for 430, 304?
I know it was in the metals market update that got sent up on the 430 side, Mike. Yep. 304, I believe, is running about 4 weeks.
Okay, great.
I was noticing that question in there.
Great.
You really are rapid firing us right now.
Yeah, good. And then the final one we have here is just breezed over red metals, but record highs, right, for COMEX right now.
We're right around them. We're within. So we've pulled back a little bit, and some of that's been on just a stronger dollar. Some of the Middle East tensions have caused kind of a flight to quality, and people have traded out of copper to a small degree. But yeah, we're still, I think as of this morning, we're like 575, and we at the record highs, we were probably 625, but we're close. We're in that realm.
Okay. Great. Wonderful. We got a few requests here for some of your charts, Nick. And there's singular ones that people have been requesting. We're gonna be publishing some of these on the Cup of Joe LinkedIn page here in the coming days. So I'm gonna drop the address here in the chat. So follow us on LinkedIn, and we'll get some of those charts out to you. Like how
you're going to give away a secret sauce?
Well, not the sauce, but just the just the toppings. How about that? Yeah.
Okay.
A few of the charts here.
We won't give away the recipe.
No, there you go. Yes.
Yeah.
Yes. Just a few of them there, but Nick, as always, great stuff. John, where could folks reach you if they want to reach you?
Yeah, Mike, my phone number. I'll get you all my contact info, and I'll have you send it out. How about that?
Yes. We'll follow up with ways to get in touch with John. So really, really interesting times. We had the plug there for the metals brief. We're putting out a lot of content on this because we know we want to keep everyone engaged on what's happening in the market. And Nick, any closing thoughts for us as we get on to the month of March?
Yeah, I guess closing thoughts would be for all of our customers. I think even all of our colleagues. I mentioned the fact that supply chain disruptions have gotten, I'd say, a fair amount worse in the last week, but certainly over the last 30 to 40 days. I guess I just want to promote confidence in that Ryerson should have supply chains in all the key products that we deal in, to ensure that our customers are not getting stocked out. So stay close with your sales reps, because these are interesting times. If you need more metal, certainly keep our salespeople in the loop on that, because it's getting harder, but it's certainly not impossible to find incremental extra units. But that's really all I got. There's a lot going on out there, but stay close to the headlines. And if you don't, we certainly will for you in the next Cup of Joe.
Absolutely.
Excellent.
Thanks, Nick. Thanks, John. Thanks, everyone. See you next month.
Thanks, everyone.